Hello everyone, the stock market rose last week as inflation eased. In fact, some stocks picked up steam, cleared key levels and ended the week with strong gains. S&P 500, a benchmark index of the US stock market, was looking bullish, and I spotted something interesting on the technical chart, which I will be covering in this video. Without further ado, let's dive straight into the usual stuff: market recap, market outlook, and technical analysis. Okay, so for last week, two key events to recap. First up, CPI aka the inflation data came in at 6.5%, which is the same as what analysts have expected. When compared to the previous month of 7.1%, it has dropped 0.6%. To add on, if you were to take a step back and look at the data, inflation has cooled from 9.1% to 6.5%, falling for 6 consecutive months. The stock market initially struggled to find its direction as it was unfazed and unimpressed with the data. However, once the market decided they liked what they saw, the major indices shot up higher. Then secondly, last Friday, America's biggest banks took the center stage and kick-started the fourth quarter's earnings. Despite the various economic headwinds, their earning reports showed continued resilience of the economy. However, the market dipped at the initial phase as the banks gave warnings on a recession this year. That being said, investors bought the early day dip as they continue to digest the better than expected results, as well as the bank's preparation and readiness for a recession. All in all, this inflation data and good earnings report by the financial heavyweights have provided a more optimistic outlook for the stock market and sort of fueled the rally. Just so you know, Nasdaq and S&P 500 notched their biggest weekly gains in about 2 months. In terms of market outlook, investors will likely put aside inflation number and Federal Reserve as companies' earnings start to take the center stage. Tesla, Netflix, and the various top US tech giants will be posting their earnings in the next 2 weeks or so. This simply means more volatility from this week till early February. To share with everyone in advance, on 30th January and 1st February, the first FOMC meeting of 2023 will take place. The Fed has made it quite clear over the last few months that they are not done with the interest rate hikes. But that being said, the market opined that the central bank is open to slowing the pace of rate hikes. The current expectation for the next rate hike is 25 basis points instead of 50 basis points. Personally, to be honest, I'm not too concerned about whether it's 25 or 50 basis points right now. What concerns me the most is how long will this high interest rate stays, and also the impact on companies' earnings and of course consumers' demand for products and services. With this, I will be paying close attention to the upcoming earnings reports from the various top US companies. Now let us move on to the technical analysis portion. I usually spend more time on SPY because it gives me a good sense of the broader market. Anyway, SPY looks really interesting to me because it is showing both strong bullish and bearish signals. Let me break them down. Firstly, it looks like there is an inverse head and shoulder pattern forming on the daily chart, and this is a bullish pattern. The neckline is at around 408, hence for this pattern to play out and be validated, it has to break above 408. If that breaks, we could potentially head towards the gap at the top at around 416 to 417, or even fly towards 420's range. Next, another potential bullish pattern is this cup and handle pattern. Again, for this to play out, we need to break above the red dotted downward trend line and then close above 408. When that happens, SPY could really fly. Okay, now let's move on to the bearish signals. But before that, if you have learned something till this point, please help me with the YouTube algorithm by liking this video and subscribing to my channel. I hope to hit 500 subscribers soon. Anyway, on the bearish side, SPY is hitting this red dotted downward trend line. If you recall, back in December, I shared how SPY got rejected on a few occasions whenever it kissed this trend line. And true enough, we got rejected again in December. With that, SPY has been rejected 4 times already, and this is the 5th time we are testing it. To put this in very layman terms, it just means this trend line so far has been working as a very strong resistance level, and mind you, it stretches all the way to January 2022. That's a year ago. Okay, so what shall we look out for in the next 1 or 2 weeks? Very simple. Watch how SPY reacts to this red dotted trend line. So let's say SPY breaks above it this week, it should retrace back at one point to backtest the trend line. If that happens and SPY holds and bounces up, then we could head towards 408. If it closes above 408 decisively, then the earlier bullish pattern of inverse head and shoulder as well as the cup and handle pattern will play out. However, if SPY could not break above the red trend line, there will be 3 key levels to watch. First, it will be the 200 moving average at 394, followed by the gap at 390 to 391, and finally the 50 moving average at around 389. These 3 levels should offer strong support for SPY. But if all 3 breaks, then good luck to the bulls, as we could slide back to 370s range. Before I move on, I just wanted to say that I have seen lots of coincidences in the stock market. Just take SPY for example. We are just 1 or 2 weeks away from the earnings reports of the top few companies in US, and coincidentally, SPY is sitting right at this downward trend line and major support current resistance of 200 moving average. To put it in simple terms, it is literally sitting on a fence between the bulls and the bears and waiting for the next big move. Well, I guess like what people always say, this market is manipulated. Let's see what kind of narrative the market makers make as the earnings are out. And trust me, you wouldn't want to be on the wrong boat. Alright, moving over to Apple. Apple looks good at the moment. Again, if you had followed my videos, you have known that I mentioned when Apple went from outside of the downward channel back into the channel, it is a good sign. I also shared that investors or traders can keep a lookout of the MACD. Guess what? MACD had a bullish cross last Monday, and since then Apple rallied quite decently. To add on, when that happened, I actually sold a put option contract, which is a bullish strategy. Personally, I think this momentum could still continue as Apple will only report their earnings on 2nd February. So from now till then, if there isn't major bad news from the company, Apple has room to run up. We could head towards 140 before hitting a heavy double resistance formed by the 61.8 Fibonacci retracement level and the 50 moving average. Do also pay attention to the top red dotted line of the downward channel. That should also form some level of resistance. If you are a bear and believe that the market is not ready to fly up yet, these 2 areas could be a chance for you to go bearish. But do set stop loss in case Apple breaks above the channel. And of course, disclaimer, this is not a financial advice. On the downside, 130 and the recent low of 124 should give Apple a support. The strongest support will be the bottom red dotted line. If it breaks below and doesn't come back into the channel like how it did recently, then there is a high possibility for us to fill the gap at 119. From there, it needs to hold 118. Otherwise, can you say this consolidation zone marked by the green lines? The range is 106 to 119. Again, if you had followed my videos, you would know that whenever a stock enters a consolidation zone, it means there is a chance it may touch the bottom of the zone, which in this case it's 106. But of course, nothing is guaranteed in this world, as Tesla recently entered a consolidation zone but did not hit the bottom of the zone. So it all depends on how much the stock has fallen or capitulated. I mean, these big cap stocks cannot keep rotting all the way to $0, right? So anyway, speaking of Tesla, that brings us to Tesla. Tesla is looking decent at the moment as well. Since we hit 101, the stock has rallied almost 20% amidst the recent perceived bad news of price cut in various markets ranging from US to Europe to China and other parts of Asia. A quick recap, I have shared on Momo that Tesla was showing at least 3 bullish signals, and so far they have been playing out quite well. Alright, come this week, Tesla needs to protect the 120 level. Ideally, if it can close above 124, where the 23.6 Fibonacci retracement level is, there is then a chance for us to charge towards 139 or 140. And to be very honest with you, if I were to purely look at the chart, heavy resistance should only come in at around 150. This means from 124 to 150, we could have a potential 26 points upside, leading to the earnings report on 25th January. By the way, if you have learned something thus far, please help me with the YouTube algorithm by tapping on the like and subscribe buttons, as I really wish to grow the channel. Okay, speaking of earnings report, Tesla's earnings result will be a wildcard. Right now, there are lots of negative news surrounding Tesla, such as missed delivery numbers, price reduction, Elon's Twitter overhang, and more. Many are also expecting a poor earnings from Tesla, so we really don't know how much have been baked into the stock price ever since we hit 101. But if let's say not much has been priced in yet, and Tesla throw us a huge stinker in their earnings, then we could fall below 120 again and fall into the bottom consolidation zone. That is when the recent low and psychological level of 100 to 101 will be tested. And what I shared earlier on touching the bottom of the consolidation zone of $90 could also come into play. But if, say big if, those bad news have been priced in and the earnings isn't that bad, I think the run-up could be really massive. Think of Netflix, Meta and Nvidia. Their run-up after a capitulation ranges from 40% to 100+%. Tesla is still far from that, which means it still has room to go up. You may catch my last video for more information on this. Alright, this week I decided to cover Google. For viewers who wish to have my view on Microsoft or Nvidia's charts for this week, can let me know in the comments section below. Okay, Google has been trading sideways for the longest time, about 15 trading days, which is about 3 weeks. And last week, it finally broke out of the sideways movement and closed above the resistance level of $90. MACD also had a bullish cross last week. From now till its earnings, which is similar to Apple on 2nd February, Google's momentum should continue, barring any surprise surrounding the company or the online advertising industry. On the upside, we could potentially slowly grind up to the next resistance level of 100. I hope that happens, and I am waiting patiently for this stock to climb up to that level so that I can sell covered call option. So let's see if that will happen before its earnings call. On the downside, $90 should act as a support now, followed by the recent low of $83. From now till earnings date, I think it's unlikely for Google to break below $83. However, if Google reports shocking results on 2nd February, the next big support below is actually in the 70s range. Well, let's visit that again when it happens. Alright, some quick end thoughts from me. We have started the year pretty well with various good news, such as easing inflation and decent earnings from the major US banks. In response to these data, investors grew more confident that the Fed could ease the pace of its tightening policy at its FOMC meeting, which is good news for businesses and of course the stock market. But before we all get too excited, I thought to just highlight two things amidst the recent market rally. First and foremost, as shared earlier, earnings season will intensify in the next few weeks, creating the potential for major swings. And don't forget, we have not really seen the impact of high interest rates on companies' revenue and profits yet, and this could just be the start. Also, rumor has it that some big tech giants have seen their poor earnings numbers and therefore have been actively taking measures to cut costs, such as laying off employees, cutting salaries, slash product prices, etc. And in case you are not aware, it is common for a company to report its earnings and other companies in the same industry experience huge price movements. Let me give you an example. Snap used to report bad earnings previously, and it caused other social media companies like Meta and Google to go down along with it. Same goes to other industries such as automakers, semiconductor, etc. But of course, some may argue that the market has already priced in all this potential bad news or poor earnings. Well, I can't be too sure about that, but I thought it's good to share with the viewers on the potential headwinds in case we all get too complacent or excited with the recent rally. Okay, the second thing that I would like to highlight is while the market has showed resilience and rallied pretty decently over the last 2 weeks, the rally was without major catalysts. Note the word major. Well, yes, we do have a cooling inflation number and nice earnings reports by the banks, but buyers may get exhausted if there is no further major push or huge good news. Once again, as a reminder, as shared earlier, S&P 500 is hitting its resistance level based on technical chart. And I would not be surprised if investors or big institution players start taking profits and risk off the table before the earnings season. Alright, that's all for this video. What are your thoughts of 2023's US stock market? Would love to hear from you in the comments section below. Lastly, please help me with the like and subscribe buttons if you haven't. Thank you.